CEO at DCB Bank, Praveen Kutti, joining in on the show right now. Praveen, great to have you today on ET Now. Thank you so much for your time. A steady performance for you. Tell me, what have been the key drivers and what visibility do you have going forward?
So we have always given guidance on a high teens growth. And Q1 has shown that there is asset liability growth of 20% and asset growth of 17%. And practically most parameters on revenue, cost, and provision front is looking positive. NIM has come at 3.3, largely driven by lower cost of funds, despite growing deposits by 20%, and the granularity continuing to be good. We have managed to knock off 14 bips off the cost of funds during the quarter. On fee income, we have seen the core fee income increase from 134 crores to 175 crores same quarter last year. And this has really helped us bridge the gap when the treasury income Q1 last year was about 101 crores. It has come down to 16 crores. We took the hit on that and still managed to deliver our operating profit growth. On the cost front, cost to average assets at a historical low at 2.42%. Our guidance is 2.5. And on the portfolio quality, we are at close to 7-year lows, or even beyond that, at NNPA 8.84 and gross NPA coming down at 2.43%. So all in all, most parameters better than the guidance. And that's the reason why Q1 has been the highest PAT following, and it's a fourth consecutive quarter we have been hitting the highest PAT.
Point taken, Praveen. I want to try and quiz you on what could possibly be the only negative, right? It's the loan growth. And sequentially, it's been absolutely flat. What's played out on that number?
In Q4, when the West Asia imbroglio started, we took a call stating that, look, this is a time to stockpile liquidity. Even in Q1, we had taken an IBPC, so around 300 crores. We've done an IBPC, which will come back to us in Q3. So our whole idea was to increase the liquidity, which is primarily come from better deposit garnering at lower cost. And we also took a step of moving the assets into through IBPC route, which is going to come back anyway. So if you were to include that, you probably see the loan growth going. In my mind, the item which I see as an area of improvement is the current account growth and the SME OD, CCOD growth. That's the area where I focus upon, not the overall loan growth. We're very comfortable with that. And you would see increased momentum coming in from the entire mortgage lab business loan segment and the agri lending segment. Demand is there, asset quality is good, and you'll see increase happening. Last part, we reduced our co-lending from 16% in Q3. It's now 12.48%. So there's more of organic growth coming in. It's a structural change that you're seeing evolving over Q4 and Q1. So I'm not overly worried about the loan growth.
If I were to try and also understand how deposit growth is shaping up, it's very strong deposit growth that you're garnering. So congratulations on that. It's a tough deposit environment and you're still doing well. Tell me, one, how are you doing that? And second, you've also got a good control on cost of funds on a sequential basis. When I've seen cost of funds has fallen, you mentioned it as well. So talk to us a little bit about those two pieces that are at play. What are you doing differently and how is cost of funds coming down?
So effectively, what we've done is we've been one of the highest term deposit players in the market. We really thought that we don't have to be the highest or one of the highest. There is merit in becoming a bit more competitive, becoming a bit more leaner and meaner. So what you see is that there's a convergence between our highest rates and the highest rates offered by the biggest banks in the industry. The gap used to be more than 120 basis points about a year and a half earlier. Now it is about 60 basis points. So effectively, we worked very hard on the term deposit. There are about 3,300 people in branch banking who we've convinced that you don't need the highest rate to grow. There are other ways of growing it, even at a lower rate. And when I say lower, it doesn't mean that we're very low. You still are competitive at 60 basis points, better than the biggest banks in the country today. So teaching and getting these mindset of the branch banking folks changed was a bit of an ordeal. But I think we kind of managed it, because Q4 also we grew by 20%, 21% rather, and in Q1 we've grown by 20%. Both times we have reduced the cost of deposit. If you were to see the last 5 quarters cost of deposit, it has sequentially come down every single quarter, and we've been growing at 20% plus. And most importantly, what people miss out is the granularity. So we haven't kind of substituted retail smaller ticket loans with large bulk deposits, which kind of alters the liability profile. So all in all, it augurs well for the future, because you got enough stockpile liquidity, and that can help us in Q2, Q3 asset momentum, which is around the corner.
And gold loans as well, Mr. Kutti, have been quite the contributor for you. Tell me, do you see this kind of growth sustain in the segment?
Well, for our bank, yes, because the base is low. So it is easy to grow, relatively easy to grow rather, by that kind of margin. I would tend to think that overall we would see 18 to 20% growth continuing throughout the year and quarter by quarter. Gold will be a large component there. Mortgages will be a large component. Agri loans will be a large component. These are 3 areas which you are betting on big time. And if you were to see the disbursals, you'll see that between Q1 of this year and Q1 of last year, our mortgage disbursals have gone up by 35%. So if you keep the momentum going, you will see the book size also going up.
Given this tilt in terms of growth preference that you're just highlighting, I believe the mortgages may be margin dilutive marginally, if at all, but gold loans could be margin accretive, and therefore how should margins shape up, if you can give us a sense of that?
I would tend to think that there will be a marginal uptick in yield, but the philosophy of the bank is to lower the cost of deposit. We want to build a franchise with lower cost of deposit. So the whole work is on getting the lower cost of deposit going, and so far we've been successful, and I believe that there is still a game in town of bringing term deposit costs down, and while work on improving CASA is continuing to happen. So very, very sanguine about NIM improvement through reduction of cost of deposit.
And it's reflecting in your stock price as well. Mr. Kutti, great to have you today on the show. 4.25% higher for the DCB stock as we speak right now. Okay, on that note, let's take a very quick break. We'll be right back. And when we come back, we'll address stocks and chat with the IDFC First Bank management as well.